Hi there, welcome to Kneppy Invest. In today's video, I'm going to be touching on Baby Bunting, looking at their financial year 22 results, and also having a look at the valuation of the company right now. With the share price falling over the past 9 to 12 months, this company is starting to look a little bit more interesting. Also touch upon whether I consider this company to be high quality or low quality, and that is quite important. I'll talk about why that is important later in the video, in fact, early on in the video. Now, Baby Bunting has been quite fortunate over the past 5 years because quite a few of their competitors in this space have gone by the wayside. And this area, this space, retail space, is highly fragmented right now. And Baby Bunting, I would suggest, and this is just my opinion right now, without any facts, that Baby Bunting is probably the largest company or infant baby retail in Australia. So I do think because it is highly fragmented, there is a long runway of growth for this company over the next decade, even longer. So that's another reason I'm interested in Baby Bunting at this point in time. We have just come out of August reporting season with many companies releasing their full year results, some companies releasing the half year results, and I'm still going through them. In fact, I'm doing it by chronological order, and right now I'm up to August 19, and I'm writing down on a list of all companies that I want to do a video on, all companies that are seeing some good revenue growth. So I hope over the next few weeks to do videos on XTech, Enero, CSL, Data3, and Kelly Partners Group. All these companies are looking interesting for various reasons. It could be the valuation. It could be simply because the revenue has been growing at a consistent rate over the last few years. Or it could be one of these companies is going to be issuing, or does look like they'll be issuing their very first dividend. And that does become an exciting prospect for the company and its shareholders moving forward. And that company that looks like they will be declaring their maiden dividend in financial year 23 is XTech. So look out for a video on that company in the next few weeks. Now to the topic of quality. And this topic has been percolating in my mind for quite a few months. And I've come to the realization that differentiating high quality companies from low quality companies is really important. Now, some investors out there might be laughing at this because you only invest, we have been told, only invest in the highest quality company. But I think people are getting confused in trying to understand whether a company is low or high quality. And for me, this is really important because the way I treat high quality companies is quite a bit different than the way I treat low quality companies. Some investors won't at all buy low quality companies or what they think is low quality companies, but I think you can buy low quality companies. But when it comes to low quality companies, it's all about underlying sentiment and the trend in the share price. And a good way to look at this, and a perfect example, is every single mining company on the ASX, in my opinion, is a low quality company because they're all price takers. They have no say how much they sell their underlying commodity for. It's all about market supply and demand. And they might have a little bit of say because some mining companies can control the supply of the underlying commodity, for instance, oil. The OPEC can control the supply of oil, which can influence the price of oil. We know that. But individual companies, say BHP, Rio Tinto, Fortescue, have much less influence on the price they sell iron ore for. And because they have much less of an influence, they are price takers. And because they're price takers, they are a low quality company because the value of the mining company is highly influenced by the price of the underlying commodity. So when it comes to low quality companies, I'm more interested in the underlying sentiment and the trend of the underlying commodity, or for non-mining companies, just the trend and underlying sentiment of the share price of that company, which is a little bit different when you're talking about high quality companies. When it comes to high quality companies, I don't really care about the underlying sentiment or the trend. I just care about the value. Is that company right now trading at really good value? For instance, if I like a pair of jeans that usually is $200 and then the share price or the price of the pair of jeans is cut in half, I'm not going to wait to see if the price of jeans is cut in half again to say from $200 to $100 to $50. I will more than likely buy those pair of jeans at $100 because it's really good value. And that's the way I look at high quality companies. It's all about value, and I don't care about the sentiment and the trend in the share price. Now onto baby bunting. Of course, the first step we have to go through in understanding baby bunting is trying to figure out whether this company is more towards the high quality spectrum than the low quality spectrum. And if you had to ask me right now, I'd probably put baby bunting more towards the high quality spectrum than the other way, which means the chart for baby bunting is less important than the valuation. And this is the weekly chart for baby bunting going back to 2015. And over the last 7 years, the share price of this company has gone up. Now, it hasn't gone up in a straight line. There's been some bad times here for a short period of times, some good times for longer period of times. In fact, from about the middle of 2018 all the way through to, say, the middle of 2021, share price of baby bunting went up, and actually went up a fair bit from $1.20 to a high of $6.60. But you have seen over the past 18 months or so, share price of baby bunting has slipped. In fact, it slipped from $6.60 to a current share price just above $4. So as the share price of this company falls more and more, the valuation of this company becomes more and more important, because I consider baby bunting to be more high quality than low quality. Now onto the financial year 22 results for baby bunting. And before we look at the results, it's pretty important to understand the current market cap of the company, because again, valuation matters. So at a share price of $4.14, baby bunting has a markup of $557 million. Now onto the revenue, profit, operating cash flow, and earnings per share for baby bunting for the financial year 22. Revenue, $507 million. Pro forma profit, a little bit different than statutory profit, $29.6 million. I'll briefly talk about the difference between pro forma and statutory profit later in the video. Operating cash flow minus leases, $30.5 million. The reason I minus leases from baby bunting, and I'm going to do this for a lot of companies now, is because about 3 or 4 years ago, AASB, which is Australian Accounting Standards Board, they started treating leases a little bit different. And in my opinion, particularly for retail companies, leasing or renting out stores is an operating activity. You can't have any operations if you don't have a store. So I do tend to decrease leases from the operating cash flow. And when you do that, you get operating cash flow for baby bunting to the tune of $30.5 million and earnings per share, 22.5 cents. Now to that difference between statutory profit and pro forma profit. And the difference is fairly big. We're talking about a difference of $10 million between $19.5 million and $29.6 million. And if you're looking at the valuation of this company, for instance, the P/E ratio, that difference between pro forma and statutory profit is quite big. And there is, it's highly important to understand why you're using either one. Why would you focus on statutory profit? Why would you focus on pro forma profit when you're looking at the valuation of the current valuation of the company? Now, this was found in the notes section in the financial statements of baby bunting. And if you start at the statutory profit of $19.5 million, you can see the adjustments the company have made to get to the pro forma profit of $29.6 million. For instance, there was a $9.3 million employee equity incentive expenses. There was also a $4.7 million transformation project expense. And there was also a tax impact from pro forma adjustments, which actually was positive to the tune of $3.9 million. And that's the reason why there's such a big difference between statutory and pro forma profit. In my opinion, the pro forma profit is a better indication of how baby bunting is performing, not the statutory profit. And that's why I'm focusing more on the pro forma profit, not the statutory profit. Now let's have a look at the revenue growth for baby bunting over the past 10 years. And this is one of the reasons why I would consider baby bunting to be a higher quality company than, say, a lower quality company, simply because the revenue growth has been quite impressive over the past 10 years. And even though it does look like the growth in revenue is starting to slow down, it's still greater than 10% per year. And if this translates into profit, say, for instance, if the margins remain steady or even increase, that means profit will be increasing by at least or even greater than 10% per year, which means your returns should be greater than 10% per year, not taking into account dividends and dividends growth. So that's what I'm looking for, a company that is growing at least 10% per year with increasing dividends. And Baby Bunting's revenue grows at a fairly consistent rate. It is growing every single year. Over the past 10 years, 16.3%, 5 years, 12.8%, and 3 years, 11.3%. And even though there is a bit of a slowdown in revenue growth, I think this company can maintain growth in revenue at 10% and maybe just a bit below 10% per year over the next decade. In this particular slide, we're looking at operating margins, which is the green line, and cash flow from operations. The reason I wanted to include this is you can see a massive jump in operations from cash flow or cash flow from operations between 2018 and 19 from 10.5 million to 41.8 million. Now, the reason why there was a significant jump in operating cash flow is because of AASB 16 and the way companies now treat leases. And the reason why I like to include leases when I'm looking at operating cash flow. The other thing I want to show you here or point out here is operating margins have grown over the past 10 years for Baby Bunting. And right now they're sitting at about 7%. So that's fairly impressive operating margins. And there is a question whether the company can continue increasing operating margins from here. If they can, and with an increase in revenue at say 10% per year, profit will be increasing at more than 10% per year. And that's exactly what you want to see for a company over a 10-year period, particularly if they can continue to grow their dividends. Your return for Baby Bunting over that period of time, that 10-year period, is going to be significantly greater than 10% per year. Now to the reconciliation of profit to net cash flows from operating activities. This is found in note 26. And the reason I like to look at the reconciliation of profit to operating cash flow is simply because I want to understand how you get from profit to the operating cash flow and what are the changes in working capital. So a lot of times the discrepancies between profit and operating cash flow is because of working capital changes. Now for Baby Bunting, they start at the statutory profit of 19.5 million, and we want to know how they get to an operating cash flow of 52.4 million. The first big number here is depreciation amortization, 31.8 million, and that includes lease liabilities, which was about 22 million. There was also a share-based payments of 7.6 million. Remember, share-based payments was one of the reasons there was a difference between statutory profit and pro forma profit. Now on to working capital changes, and you'll find this in the changes in assets and liabilities, focusing on receivables, inventories, and payables. Not much difference in receivables, a little bit of an increase in trade and other payables, $4 million, but there was a significant increase in inventories over the past year, a $16.7 million increase in inventories. So Baby Bunting is stocking up on supplies or products that they want to sell over the next year. Now onto the valuation. This is quite important for a company that is high quality. So we want to see if there's any really good value with Baby Bunting right now. Now, based off their pro forma profit, we have a PE ratio of 18.8. If you're using statutory profit, that PE ratio would be well above 30. And if you're looking at a PE ratio of being well above 30 for a company, and even if it's growing fairly good, you might be saying right now, well, that valuation of this company is a little bit too rich for me. Price to sales ratio 1.1, price to operating cash flow 18.3. Again, if you're just focusing on the operating cash flow, not taking to account lease liabilities, the price to operating cash flow would be more like 10 or so, which would be shouting out, maybe this is really good value. So again, the reasons why I've made those adjustments to profit and operating cash flow is to give a more realistic guide to the valuation of a Baby Bunting right now. Now, I don't like to do DCFs, but I don't mind doing reverse DCFs just to see what the growth rate has to be of Baby Bunting over the next 10 years to justify the current valuation. And we get a growth rate of 16% per year, which is not too high for this company because it's already growing at a fairly similar rate. So right now, I think Baby Bunting is fairly valued. If I see the share price of this company come down, say 25, 30%, that could be some attractive valuations for this company. So again, I won't care if a share price is in a downtrend. If I see some value with Baby Bunting, I would be taking a position in this company because I do think it can continue to grow at fairly good rates over the next 10 years. Now to the chart for Baby Bunting, and this is more important for lower quality companies, but I still like to look at the chart for even these high quality companies, particularly if I see some really good support levels or resistance levels. For instance, if the share price falls below $3.40 for Baby Bunting, which was the last low we saw back in June, that would be a bearish sign. But that doesn't mean I won't take a position in this company. But if I see the share price bounce off $3.40, maybe if I see some good value in this company at that point in time, maybe that could be a good time to take a position in Baby Bunting. That's all I have for this video on Baby Bunting. It's taken me ages to do this video. I haven't been in the mood to do any videos, but I hope you've enjoyed me looking at Baby Bunting and their financial year 22 results. If you disagree with me in regards to whether this company is high quality, if you think it's a low quality company, I'd love to hear your opinion why. So leave it in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.